Hello and welcome to Business 101 Online. I'm your course instructor, Heather Hines. Here we're going to be talking about Chapter 5 and how to form a business. Now there are three major types of business ownership. There's sole proprietorship, partnership, and corporation. In our first critical thinking question, we have a scenario with Carlos and his brother, Don, where his brother provides Carlos with $50,000 to start the business, and in return, Carlos gives his brother 20% of all the profits. So it's asking, what kind of business is this? Is it a sole proprietorship, a joint venture, a general partnership, a limited partnership, or a C Corp? And we're going to be talking about all those different types of ownership in just a minute. Now, these are the three main types. Again, sole proprietorship, where it's just one person owning and managing the business. This is the easiest one to form. Then there's a partnership made up of two or more people. And then there is a corporation where your owners are legally separated from the business. And each of these has some subgroups in it. So we'll talk about each of those in just a few minutes. When it comes to forming a business, most businesses, 72% of your businesses, are actually sole proprietorships. Why? Because they are very, very easy to open. You just fill out a doing business as form at your local city office, and boom, you are now a sole proprietorship. All you have to do is state that in your taxes. It'll be a pass-through, meaning whatever your business makes, it will pass through you as your own personal income. 8% are partnerships and 20% are corporations, whereas the bulk of your sales are from corporations. So while corporations only make up 20% of the businesses, 81% of revenue is made up of from corporations. So remember, revenue is a little bit different than profit, but kind of the same idea when you're talking about the overarching scheme. 81% of your revenue comes from corporations, whereas only 13% from partnerships and 6% from sole proprietors. Now, what are some benefits of having a sole proprietorship? Well, it's very, very easy to start your business. You're your own boss. You don't have to consult anybody else because it's just you. Now, what are some disadvantages? Well, because it's so easy to open, so for example, you want to do a cake business, so instead of creating a separate entity, you pretty much just take out a credit card and it's under your name and you buy all the things for your cake business. Well, one of the drawbacks is now you have unlimited liability. In order to leverage the money needed for your cake business, well, maybe you're using your own personal line of credit. Oftentimes that's the case. And so your personal assets are on the line. If you own a house, if you own a car, now those personal assets can be repossessed by whoever is lending you that money. And you have limited financial resources. Why? Because it's just you. So you are going to the bank by yourself trying to get a loan. So not too many financial resources there when it's just you, one person. You might have some management difficulties. Why? Because maybe you have this great idea for a cake business. Maybe you're a great chef and you can create these amazing cakes, but maybe you don't know anything about management. There's a lot of time commitment. A lot of sole proprietors spend 80 hours a week in their first few years. There aren't very many fringe benefits like health benefits, daycare, limited growth, and limited lifespan. So the limited lifespan, if you pass away, then your business also passes away with you. So it is not transferable upon death. The assets are, but the business itself is not. Next, we have partnerships. Partnerships, remember, is when you have two or more people. There's four main types. There's a general partnership where you just have a couple of manager owners who operate the business, and they have unlimited liability. So general partnership is basically the same as a sole proprietorship, but with 2 or more people. Then you have a limited partnership. That's where you have a general partner. Remember, a general partner is somebody who actively owns and operates the business. And you have a limited partner who does not actively own and operate the business. And that limited partner has limited liability. So you have a general partner. In a limited partnership, you have a general partner, one who actively owns and operates the business, and they have unlimited liability, which is bad. And then you have a limited partner who basically just gives money, but they aren't active in the business, and so they are now considered an investor in your partnership, and they have limited liability up to the amount that they have invested. The other 2 types of partnerships are master limited partnership and limited liability partnership. Now, master limited partnership kind of has the best of both worlds. However, you have to fill out different paperwork, and it's a little bit harder to form. So master limited partnership kind of looks like a corporation, but it's taxed at the individual level. So you'll kind of hear that. If you haven't heard that term before, then you should become familiar with it. So if you're taxed at the individual level, that means that when the business gives money to the owners, then it is taxed to the owners at their individual tax bracket. So you might be in the 33% tax bracket, you might be in the 22% tax bracket, whatever you're normally taxed at. You, as an individual. Then there's the corporate tax. If you haven't heard, Trump just recently lowered the corporate tax to about, I think, 21%. So that's what it means to be taxed at the individual level versus the corporate level. So for a master limited partnership, you're taxed at the individual level. And technically, you don't have any employees, just managers and owners. So you have basically only general partners and investing partners, but they have a little bit of limited liability. Then you have limited liability partnership, where you have no general partner, meaning you don't have any owner operators. You have limited partner risk, and this is the hardest of the partnerships to form, but probably one of the best ones to actually form. No general partner. You have limited liability to whatever you're bringing, to the assets that you're bringing into the company. And the only problem with the limited liability partnership is you have to be very, very careful of commingling your assets. So you cannot have personal assets and commingle them with your business assets. You need to be very, very careful about keeping your assets separate. So that's one of the tricky things about forming a limited liability partnership. What are some advantages of partnership? Well, the more people you have, the more financial resources you have, the more people you have to draw money from. You have pooled resources and management. You have longer survival, right? Because now instead of waiting for one person to pass away and that the business perishes with one person, now you have multiple people. What are some disadvantages? Well, unless you have the limited liability partnership, you have unlimited liability, and you have to divide profits, figure out how you're going to share profits. You might have disagreements, and it is also difficult to terminate. So say you develop a partnership, and you say, oh, I don't like doing business with you, I quit. Well, now it's very difficult to dissolve and terminate the partnership. Lastly, let's talk about corporations. Corporations are kind of your ideal type of business. Why? Because it separates the owners from the business. So now you have what's called limited liability. Limited liability is a very good thing. It means only the money that you put in is at risk. Your personal assets, your car that you drive, your house that you live in, those types of things are not at risk. So only the money that you put in is at risk. You can easily change ownership. So, for example, if I own 10 business stocks in Disney, then I can easily go onto the stock exchange and sell them to anybody I want. You can now attract more talented employees because you're larger. And again, you have the separation of ownership from management. Now, with a corporation, you will generally have your owners, who are your stockholders. Those owners will usually vote and elect your board of directors. And your board of directors generally go out and they hire the CEO and other corporate officers. So remember, we have the CEO, kind of like Jeff Bezos of Amazon. You have the COO and all those other, we call this the C-suite because all their names start with C. Then we have the managers and the employees. So what are some disadvantages of a corporation? Well, it has a lot of cost and paperwork to start. You have what's called double taxation generally, especially for C Corps. So double taxation, what is that? So basically, the corporation, so let's talk about Amazon. The Amazon, let's just say they make $1 billion, but then they're taxed at the corporate level, let's just say 21% of that $1 billion. What is that? $21 million in taxes. And then they go around, they turn over to their owners and say, who own stock, and say, hey, we are going to pay you out in the form of dividends. So that's generally how corporations pay their owners, is through dividends. Their stockholders, they pay them through dividends. So then they say, hey, we're going to pay out dividends. And so you are a stockholder. Now you have to pay taxes on those dividends that you received. So the Amazon had to pay their own corporate taxes, then they distribute out the dividends, and you as the owner receive those dividends, you have to pay taxes on those dividends. Ouch, right? And those are going to be at your personal level. So you have to pay corporate level taxes, the corporation pays their taxes, and then you yourself have to pay your own taxes. Usually they're very large, they're very, very difficult to terminate, and generally you might have a conflict with the stockholders and the board of directors. So the stockholders might say, hey, we really, really want to see a lot of growth, a lot of profit this next year. So the board of directors might say, no, we want longevity, we want to make sure that we are maintaining our equipment, so we need to take some of our profits and reinvest it in our equipment and our employees, and that might conflict with the stockholders' purview. There are many, many different types of corporations that you can, forms of corporations. We're going to focus on 3 types of corporations. There is the conventional corporation, which we call the C corporation. That's where you go to your state, you create a charter, you tell them this is the business I want, you fill out all this paperwork, and boom, now you are a C corp. And you have stockholders. So you're selling stock or stake in your company. Then we have an S corp. An S corp is very similar. It's kind of a hybrid. It has some of the benefits of C corp, and it kind of looks like a sole proprietorship. So for an S corp, you have your taxed at the individual level, like sole proprietorships. However, you can have shareholders, so you can sell stock in your company, and that allows them to have limited liability. And the profits are only taxed once. So remember, the disadvantage of corporations, particularly the C corp, is the double taxation. Well, for an S corp, it's only taxed once. However, for an S corp, there are some limitations. You can only have 100 shareholders. All the shareholders must be U.S. citizens. You can only have one class of stock. So there's common stock, and then there's preferred stock. So you can only have one class of stock, which is generally going to be your C stock, not preferred stock, common stock, I'm sorry. And then only 25% of your income can come from passive sources. So passive meaning you just invest in something and you make money. So, for example, if you take $1 million and you put it in the bank and that's how you're making your money, that's called passive income. So only 25% of your money can come from passive sources. Lastly, let's talk about an LLC. This is extremely common. In fact, some of your large corporations are still LLCs. Why? Because they are the best of every world possible. You have limited liability. You have a choice of taxation. Do you want to be taxed at the corporate level or at the individual level? You don't have the double taxation, so you get to choose corporate or individual. And but there's still a lot of paperwork to fill out. So all corporations, you have to fill out paperwork with your state. Critical thinking number 2 question says, what are some advantages and disadvantages to a limited liability? Well, make sure that you talk about taxation. You do not have double taxation. You get the choice, right? And also you have limited liability. So that means that the liability that you have is only the assets or the money that you bring to the table. Your personal assets are not on the line. However, you have to be very, very careful when you're creating an LLC to not commingle your assets, because if you do and somebody sues you and they realize that you had commingled your assets, well, then you don't have that limited liability. But that's, for business law majors. And then the question goes further and says, can Carlos and his brother create an LLC? Why or why not? So make sure you understand what is an LLC and who can create it. Basically, anybody can create an LLC. What are some disadvantages? Well, you have that limited lifespan. So once the owners pass away, then your LLC is no more. You don't have any stock, therefore you can't have your ownership isn't transferable, which is kind of why it has a limited lifespan. And you have a lot of paperwork. So we just talked about the 3 major types of ownership. We have the sole proprietorship, which is the easiest to form. We have the partnership, which is 2 or more individuals. And we have different types of corporations. We talked about 3 corporations: the S Corp, the C Corp, and the LLC. Now let's talk a little bit more about corporations and the types of things that they can do. Corporations can merge together. That's 2 or more companies merging together, becoming one company. Or you can have an acquisition where one company buys out another company. Mergers can either be vertical or horizontal. So make sure you understand those 2 different terms. We'll see vertical mergers, vertical integration. So make sure you understand the difference between vertical products and horizontal products. So vertical mergers or products are when you have things that are related in the same chain. So for example, Amazon, they sell batteries. For example, they are also starting to make their own batteries. So they might purchase a battery making company, and that would be called a vertical merger. So vertical merger is where 2 companies, they merge, but they are in different stages of the same business. So a battery making company would merge with a battery selling company. That's a vertical merger. Horizontal merger is when 2 firms that are basically doing the same thing join together. So horizontal merger is when you might have one, battery making company, Duracell, combines with another battery making company. And then you have a conglomerate merger where you just have unrelated things merging together. For example, you might have a conglomerate merger of a battery company with a company that sells water. Why would a company want to merge with an unrelated company? In order to diversify their portfolio, meaning you don't have all your eggs in one basket. Now, in terms of acquisition, you have something that's called a leveraged buyout, so LBO. It's when the employees, management, or a group of investors pulls together and say, hey, I'm going to go take over this company. There's a couple different ways that they can do it. There's a hostile takeover where they just go into the stock market if it's a publicly traded company, and then they just buy a bunch of shares of that company until they're the majority. They have the voting majority. Remember, shareholders, they vote for the board of directors and the C-suite, the CEO and all those other managers. So if they have all the voting power, if they hold most or all of the shares, then they have successfully bought out the company and now can take control and go and make decisions for that company. Remember, we talked about franchising in another chapter. When we talked about risk and reward, franchising was kind of there in the middle. Franchisers are actually generally much more successful than just opening up your own business from scratch. Why? Because you have brand and name recognition. It's already something that's proven to, you already have a customer base of customers that already like that product. You already have customers that recognize that name. And then when you're franchising and you're the franchisee, if you're the person buying it, then generally the franchisor will also give you kind of this business plan of, okay, so this is your management structure. This is kind of a recipe of how to maintain a good business. So again, some of the advantages of franchising are that it has a low failure rate because it's already recognized. And sometimes you even get financial assistance from your franchisor. What's the disadvantages? Well, it has a higher startup cost. Why? Because you're buying the franchise. You have to buy that franchise and you have to share some of your profit. Generally, part of the agreement is that you give 2% of your revenue or your percent of your sales or profits to your franchisor. You have there might be some different management regulations that you have to adhere to, or some restrictions on selling. Alright, so that concludes our discussion of Chapter 5 and how to form a business. Remember, you still need to go read the textbook, complete the EduCredit, take your quiz, and complete your critical thinking questions.